So I don't want to say that we're in a stock market crash or recession, but I will say that we're in a very interesting point in time in the stock market. There's a lot of different factors at play right now, and it's resulting in some very volatile times in the stock market. And if you're an active trader, this is the opportunity to make a lot of money, but it's also an opportunity to hurt yourself massively for the short term future. Now, personally, what I'm looking at doing right now is just to preserve my capital. So you're seeing me moving away from option plays right now and just kind of sitting on the sidelines a little bit more. I'll be taking advantage of the higher VIX to get further from the money when I'm selling my options. And I even think that some of the better plays right now might be to actually buy stock. And I know that sounds strange coming from an options trader that really loves options, but stocks can be part of your portfolio too. So first off, you first off, just looking at the Nasdaq, you can see that we've had a really crazy start of the year. In January, we gave up some massive gains, which happens every so often. Every 6 months, it seems to have a giant dip, but then it tends to recover. So it's tough to go bearish, but with the volatility and other things that are happening, like I think it's still not time to buy the dip. Just kind of wait and let the market show you its hand. Uh, but looking back in the time, anytime it dips, you see it goes right back up, and that's been like the last 2 years. Let's go 5 years out, and again, anytime it dips over time, it goes back up. This is why I tend to be long-term bull. But this dip that we have right now, or this correction, is probably healthy overall. So the government printed a lot of money over the last 2 years because of the pandemic. I think they printed like 3 times as much money than they did for World War II. You can't print that much money or create that much money and not expect inflation to become a factor. And so now the government's facing an issue where they have the threat of inflation or hyperinflation. And the way to battle that is going to be to raise interest rates, which of course can potentially crash the market. So they have to decide between inflation and slowing down the market. And right now, they're saying they're going to raise interest rates. So again, the market is reacting to that. The other thing I think is something that you should think about is over the last 2 years, like a lot of people that don't have money usually had extra money because of all the stimulus packages, unemployment benefits, like everything that went out there. A lot of people that don't normally have money had money. And what were they doing with that money? They were spending that money. And a lot of companies were having record growth, year over year growth, record profits, even though we're in the pandemic. And that's because there's just so much money circulating going around. But as we're raising interest rates and stuff gets more expensive now, people will be buying less. So you'll see like those earning reports start to go down eventually over time. Right now, I think they're still benefiting from when people still had more money. I think we're going to see that trend downward. And unfortunately, I think the market was looking at that growth and really extrapolating future in time going with that. So stocks got a little overpriced, and I think we're starting to see that correction come in a little bit now as inflation gets attacked by the Feds by raising interest rates, and we start seeing earning reports turn back to normal. People will be like, oh no, the growth is slowing. And again, the stock market is looking for any reason to lower the stock prices right now, it seems. If Apple and Microsoft didn't have insane earning reports, I think the Nasdaq could have dropped down to like 11,000, and I think people would be really freaking out. But right now they're not, and I don't know if this is the bottom. I think we might still go a little further down, but I won't be too worried until we start seeing like precious metals going up. When people start moving money from the market into precious metals, that's usually a sign of something drastically bad is going to happen. And if you look at like gold and silver over the last 6 months, like it hasn't really been going up crazy. I mean, there's been a couple spikes here, but nothing out of the normal here yet. So I think we're going to be fine in the stock market. We're not going to have a massive drop from this point, although it might go down a little bit more. No one's going to be able to time the bottom perfectly. So I don't think options are the best play right now because of all the volatility and the potential for stuff to go on. The other thing we have going on is like there's international tension with potential wars, and then you have Russia saying they're moving the troops, and other people saying they're not pulling their troops back. Like there's a lot of tension that is also creating more uncertainty in the market. So the market is moving really fast on like the littlest news, and even seems to be moving on made up news or news that it just wants to pretend is a thing. So something I've been looking at as well is like basically a lot of stocks are at multi-year lows now. Like this is the time to buy, or at least DCA in. Look for those stocks that you actually want to hold long term, and think of this as a fire sale. Like dividend investors are probably celebrating right now. They're getting a great yield on cost. Uh, An example of that would be right now Intel. Intel is down to 45. And if we look at the 5 year, this is going all the way back to like 2017. Like this is a huge sale. Your dividend yield on cost right now, I think, is be like 3%. Or right, there you go, 3%. And okay, that's pretty good. So like, there's opportunities to go long in positions right now. Maybe don't be selling options during this time. If you do, only sell it on stocks that you really want to own because you might get tested. We don't know where the bottom is going to happen. I'm more bullish than bearish at this point, and I even bought like some far out of the money calls as like a little lottery ticket. I think that if tensions internationally kind of go down a little bit, SPY is going to shoot right back up to like 480, and there could be some massive profit capability right there. But don't get too crazy buying out of the money option plays or stuff like that. Only play with money that you can afford to lose. Right now, like I said earlier, I believe, I'm looking to just preserve my capital during this time until things settle down a little bit. There's just a little too much stuff going on. Uh, Something else that surprised me was like Dropbox. Dropbox has beat earnings like 4 times in a row, and today like they dropped like 5%, even though they beat earnings. Like the stock market is just really looking to drive those prices down right now. Can't tell you what the main factor is that's trying to do that, but all these companies seem to be reporting really good earnings overall, but the prices just don't reflect that, and it's just kind of crazy to look at. So again, like this is a company that you would not expect to go down, especially after good earnings, and here it is down like 3% right here. Just play safe, guys. Like, you don't have to do options, even if that is your main strategy. You have more tools in that toolbox to use. Look for those stocks that you can just buy, or maybe look for buying some Leafs. Although I think the VIX is actually pretty high, so even Leafs are a little expensive, which is why I think like looking for stocks that you can buy and hold long term might be the play right now. Even though it's not the most exciting thing in the world, but it might be the safest and one of the better long term plays if you can hold a play for a long time. And if you don't think that you're a good stock picker, like that's okay. Go ahead and check out like those index funds and ETFs. Like they're really good, and even some of those income funds like Devo have been holding up pretty good during all this volatility. I mean, just look at Devo on the graph right here. If we go year to date, Devo started off at 38.40. It's only down to 36.72, so it's barely lost $2. The yield that you get, or the monthly income, will give you 5% a year, and that's just dividends that can get reinvested. And like this is an income fund that seems to be doing pretty good. Some of the other from the Crowdfecta portfolio would be QYLD. QID is still above 20. Well, actually, it's barely above 20. But again, this started off trading at 22. It's only down $2, and it's actually held up pretty good during all this volatility again. Like I was actually really surprised by QYLD and how it didn't drop a lot more than it has. If you like this video, go ahead and check out the video that's coming up right here, and have a good time, guys.